OPEC losing one of its oldest members, Qatar announcing it's going to leave the cartel after a 57-year membership. The surprise departure comes as the country looks to focus on boosting gas production, and it comes ahead of this week's OPEC meeting. Joining us now, the Schork report publisher, Stephen Schork. What do you make of this move, and what happens at the OPEC meeting later in the week?
Well, hi, Degan. Certainly, the move by Qatar is absolutely symbolic, and symbolic only, being that this is the first Persian Gulf country to ever leave the cartel. We've had other countries leave, come back, suspend their membership, but Qatar is the first Persian Gulf. And it's symbolic in the fact that we have to keep in mind the country only produces fewer barrels of crude oil than the state of New Mexico. So given the relationship, the frayed relationship with Saudi Arabia, given that certainly the country produces about 2% of OPEC's oil production, they are under Saudi's thumb. So you leave OPEC, you focus on LNG, natural gas. The country produces about a third of the globe's production. Therefore, you get out under the thumb of Saudis and you focus on your future. Your future is not crude oil, it is natural gas.
What do you make of this Saudi Arabia and Russia making a deal ahead of the OPEC meeting? Unclear how much Russia will curb output. The Wall Street Journal has an article today saying, well, the cartel make the same mistake that they did in 2014, where they didn't curb production enough, and you had a 2015 slump that rippled across not just the commodities markets, but the stock and debt markets as well.
Of course, and it wasn't just in the crude oil market in 2014, 2015. It was the entire industrial metals complex. And this was a function of a pullback, a complete slowdown in demand growth. So it's also an issue. But when it comes to OPEC, we always want to focus on supply. We always seem to forget about demand. And demand is certainly stronger. The economy is stronger than it was 3-4 years ago. So I'm not too concerned about this. We have to keep in mind, Degan, and I've been saying this on the show for the past 4 or 5 weeks, that crude oil is searching at a bottom. We have to keep in mind that the pullback over the last 2 months in oil prices from about $75 to $50 was an implosion in a bubble that was promoted by Wall Street at the end of the summer with regard to Iranian sanctions. Remember those? Because 2 months ago, Wall Street's best and brightest were telling us oil was going to rally $25 from $75 to $100 a barrel. They got the $25 right. Unfortunately, they got the direction wrong. So we did come off $25. Demand is much stronger now. We're coming out of seasonal maintenance. So demand by refineries picks up. Demand by motorists picks up as we start driving to the malls for the holidays. So demand is at a point that if oil is going to find a bottom and move higher here, this is the starting point.
What is a reasonable price here, an accurate price? Can you throw out a number?
Yeah, absolutely. When we're looking at where we are at fundamentally, economically, as far as refinery economics, or excuse me, production economics go, we're at the bottom. Perhaps we're about $5 below. $55 is more of your comfort range at that point. You don't want to see oil prices certainly below where we are now, $50 a barrel. A number that would be good for the entire industry, $65 average for the year.
Stephen Schork, always a pleasure. Thank you so much for the insight.
Thank you,
we will
Degan.
see you soon.
Sure.